Hello, my name's Chris Pedersen, and this is Stock Watch on Wednesday, the 10th of January, 2024. All advice is general advice and might not be suitable for you. Always consult your financial advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. Here are a few market observations for the start of 2024. Interest rates are bouncing after a big drop at the end of last year. Because interest rates are around 7 and 10-year maturity level are rising a little bit, the markets are weak. Inflation is under control. There's too much talk of recession right now, which to me means it probably will not happen. Many companies in Australia are struggling with revenue growth. However, not all of them. Look at these. Here are 4 companies I wanted to highlight today. First is Santos. The code is STO. It's currently trading on the ASX at $7.50. Taking a look at this chart, it's a 5-year chart. It has a history of going up and down, but bottom line, it's not really making any breakouts. It's also not dropping. Santos is an oil and gas company. Let's look at the fundamentals. These are from Macquarie, by the way. Santos has a market cap of around $24 billion. The 12-month price target, according to Macquarie, is $9.60. Revenue growth from 2023 to 2026, they estimate at negative 7.6 per annum. The EPS growth in the same period is negative 19% per annum. However, the dividend growth rate, they estimate is positive 20% per annum. PE on the 2024 earnings estimate of 63.7 cents. Now going back, they report in US dollars. I'm converting the US dollar earnings to Australian dollars at an FX rate of 0.675. This happens to be a PE of 11.8, which is cheap. The yield on the 2024 dividend estimate of 28 cents is 3.7%. Free cash flow is around 3% and the payout ratio is 40%. As mentioned, it's an oil and gas company, and prices of these commodities are very volatile. It's got a possible merger, which is code WDS, speculated on. If this goes through, which even if it does, we don't know what the terms are, but based upon current valuations without a takeover or merger, the valuation for Santos is a little bit cheap right now. Now, when I drilled into the price of oil, it's using around $65 per barrel for these forward earnings estimate, which means there's a little bit of downside leeway and you'll still outperform these numbers. However, because of the volatility, because of the possible merger, I rate it as speculative. I like companies that have more certainty of future earnings. However, for those that follow oil and gas or are comfortable with it, Santos looks attractive. Platinum Asset Management. The code is PTM. Trades right now on the ASX at $1.23. This is a 5-year chart. I haven't seen many charts that are this bad. I mean, it just is down, down, down. Kerr Nielsen has lost his magic touch, apparently. Just looking at this chart, I would rate it a sell. However, let's look at the numbers because maybe it's not. These are Citibank estimates, by the way. There's a market cap of $5.1 billion. 12-month price target, according to Citi, is only $1. So that's down quite a bit from current price. Revenue growth rate, looking at 2023 to 2025 period, it's negative 9% per annum. Earnings per share, same period, is negative 17%. Dividend growth, negative 20%. Well, based on forward estimates, this is terrible. The PE on 2024 earnings estimate of 10.9 cents is only 11.3 times. However, a company that is just going backwards, who cares what the PE is? If the future earnings continue to drop, no matter what price you pay, you're going to end up losing money. The yield on the 2024 dividend estimate of 10.4 cents is a huge 8.5%. Do not get fooled into thinking this company is great because it has a high yield. It has a high yield now, but Will they be able to continue paying 10.4 cents? Well, if their earnings keep dropping, of course not. The payout ratio is 95%, which means they don't have any leeway to increase the payout ratio to keep the price up. Platinum Asset Management specializes in international equities. To me, it's a good example of creative destruction, which is an economic term of companies that go out of business, creating opportunity for other companies. Do not touch Platinum until they show signs of life, is my view. This company can keep going down. However, if funds under management start to increase, if their performance starts to turn around and get better, then this company could be a screaming buy. Right now, stay away. Third company is Link. This is an administration company. The code on the ASX is LNK. It's trading right now at $2.19. Another company that it had an amazing beginning. It got taken over, Pacific Equity Partners. Then it floated. It went way up in price. Now the past 5 years, it's just been going down. However, the company came in with a takeover bid. That's why at the far right, you see the stock price spike up some. However, as you see, this spike up is still nowhere close to where it's been trading previously. Looking at the numbers, these are Macquarie estimates, that the 12-month price target they have is $1.25. Now bear in mind, it's trading at $2.19. So if this bid does not happen, which they've signed a contract and there's a 1% break fee, then the stock can really drop from the current price, but maybe not. Let's look at it. Revenue growth from 2023 to 2026 estimate is also negative 6% per annum. Earnings growth, same period, negative 9%. Dividend growth, same period, plus 2%. So there's a small positive out of a sea of red. The PE ratio on 2025 earnings estimate of 14.3 cents is only 15.3 times. So this takeover is happening at around a 15-time multiple. That's pretty cheap, by the way. The yield on the 2025 dividend estimate of 9 cents is 4.1%. That's reasonable. EBITDA growth, however, looking forward, averages around negative 3.3%. That's not good. The payout ratio is 60%. Link Administration is the largest superannuation administrator of funds in Australia. This is a risk arbitrage deal. The rates of return and the numbers are on this page. Right now it's trading at $2.19. So if you buy it here, let's look at how it pans out. The sell or the tender price is $2.10. However, you will receive a 16-cent dividend that is around 20% franked. They say up to 25% franked, so it's definitely not fully franked. That's maybe 1.4 cents. So the total profit is $2.10 plus 17.4 cents minus the price of $2.19. That's an 8.4 cent profit. Now the cash proceeds are estimated to come before the end of this financial year, around 165 days from now. If you annualize out this profit, it's a rate of return of 8.5%. This is attractive because it's almost a done deal. There is not much room for this to not go through. As a risk arbitrageur sitting at Goldman Sachs or Morgan Stanley or one of the huge investment banks, I would leverage this by borrowing money at the overnight rate. Well, the intermarket rate is the bank bill swap rate, but the large funds like Goldman and Morgan Stanley, etc., borrow cheaper than that. So if you're borrowing at, say, 4% or 4.25%, and you're getting 8.5% return, the leveraging up as much as you can gives you massive rates of return. This is how risk arb makes its money. Dependent upon transaction costs, maybe you can do the numbers and see if it's attractive to you. Last company I want to show you is something I read over the weekend, and it deals with tire manufacturers globally. An interesting fact about electric vehicles is because they're so heavy, the wear and tear on tires is a lot more than a regular petrol or diesel vehicle. Accordingly, tire manufacturers globally are going to be selling more and more tires as the growth in electric vehicles continues to grow, i.e., tire manufacturers have good positive growth perspective for the next 5, 10, 15 years. Now looking at that, UBS had a research report, and this is a summary of European tire manufacturers. I decided to take a look at Pirelli because that's their number one on the list, and it's trading euros 5.20. Let's look at some of the numbers. The important one is the price-earnings ratio on 2024 earnings estimate of 40 euro cents is only 13 times. This is cheap for a company that has good future growth prospects. Now, as mentioned, electric vehicles are heavy. This is something that is not really thought about in the investment market. But as time passes, these tire companies will only be selling more and more tires. Yesterday, the stock jumped due to a large Italian investor increasing their holdings. So I'm not the only one looking at Pirelli. An existing large shareholder is increasing their stake, so they see something positive too. As always, if you want to learn more about anything I covered today, send an email request to stockwatch@fnn.com.au and address it to me, Chris Pedersen. I hope you had a wonderful Christmas and New Year's, and 2024 is profitable for you. Have a great rest of the week. Thank you.